Yahoo Finance says that investors are warning that Omicron and the Federal Reserve Bank are a risk in the growing but slowing economy. CNBC says that wealthy investors want to own less of their investments because everything's in a bubble in 2022. And if we go back to Yahoo Finance, JP Morgan, the biggest bank in the world, says that investors are too bearish and there's no sell-off in sight. Let me just read you the first sentence of the article where JP Morgan Chase Bank says that there is no market crash coming and we are going to see the market boom in 2022. There is little reason to fear that the rally that catapulted the United States stock market to records in 2021 will end soon. JP Morgan Chase Bank says that in fact it might get broader in 2022. Now, I know I said just a second ago that JP Morgan Chase Bank is the largest bank in the world. They are not the largest bank in the world, but they're up there. They're one of the largest banks in the world. And they say that we're going to see a continued stock market boom in 2022. That's great news if you're a stock market investor. If you are not a stock market investor, that could be good news or bad news. If you're putting your money into the market and you see a boom, that's good news. If you want to invest your money in the market, but you're not ready to, well, then a stock market boom is bad news, because that means that when you are ready to invest in the market, it might be a whole lot more expensive and cost you more dollars to go out and invest your money in the market. That's one of the side effects of inflation. Inflation makes your buying power less with the dollars that you have, and that also makes it harder for you to go out and invest money because assets, things like stocks and real estate, become more expensive because as you print more money, the value of each individual dollar goes down, causing the price of things, including assets like the stock market, to go up, because one of the places that people put their money to go and combat inflation is the stock market. But I'll talk about that in just a little bit. But going back to this article, it's very interesting to hear what JP Morgan Chase Bank thinks is going to happen. So let me go back to this, because they say that the conditions for a large sell-off are not in place right now, given already low investor positioning, record buybacks, limited systemic amplifiers, and positive January seasonals. So what they're saying is there are 4 reasons why you're not going to see a sell-off, why you're not going to see a crash in the stock market. The reason number 1 is you have low investor positioning. I talked about this in 2020. When you started to see the stock market rally, everybody was wondering, is the stock market rally going to last? And one of the things that I talked about is you have to look at investor positioning. Investor positioning is how much cash is sitting on the sideline. Because if investors are fully invested, if people have all their cash in the market, well, then there's no more ammo to boost the stock market up even higher, because the stock market is priced by supply and demand. When you have more buyers than sellers, this pushes the price of stocks up. Because if you are selling a stock for $10 a share and me and 10 other people want to buy your stock, and now we're bidding for the stock that you have, and now I have to offer $10.25 to buy your share, well, then that's going to push the price of stocks up, because you have more buyers than sellers. More buyers are bidding for the stock than people selling the stock. But if all the buyers are cashed out, they're tapped out, they have all their money in the market, and then you go and try to sell your stock for $10, well, none of us have any money to invest. I can't afford $10. So you might be forced to cut it to $9 to entice somebody to say, okay, I think I can round together $9 and go out and buy your stock. And so what this article is saying is you still have a lot of cash on the sidelines. And part of the reason for that is, well, one, we had all this inflation, we had all this low interest rates, so a lot of corporations, a lot of people have access to more dollars. You have a lot of people that are sitting on equity in their homes. A lot of people have been refinancing their homes and they have cash in the bank. You have people and institutions that were able to borrow large sums of money, millions of dollars at low interest rates. And this is now buying power. This is the ammunition. And they're saying that a lot of it is still sitting on the sideline. And so if this cash is waiting there to be deployed, well, then there's more opportunity for the market to go up, as long as there are dollars waiting to be invested. Once all the money is invested, well, then that's when you can really start to see a market slow down, because then there's no more money left on the sideline. So that's what they say. The second thing that they talk about, make sure I don't miss it, are record buybacks. Stock buybacks were under a lot of criticism in the 2020 pandemic era, during the 2020 time, because we saw airlines that were doing massive buybacks before the pandemic hit. So you do a buyback because you have a lot of cash left. You have profit in your bank account. So your company makes a lot of money over the year, and now you could invest this money in more growth. You could save this money, but you don't want to do that. You don't have a way to invest it in more growth. You don't find that opportunity. You don't want to save it. Either you have savings or you don't want to save more money. So you want to put this money to work. You just don't know where. And so what a company will do then is they can either give this money to the shareholder in the form of a dividend, but then you're going to be taxed because if I give you cash, it's income, or I can use this cash to go out and buy my own stock. And now if you have billions of dollars going to buy your own stock, like remember what I just said, supply and demand. You have more demand when you do a buyback. You have billions of dollars going to buy your own stock. This is going to push the price of stocks up. And so what we saw happen in 2021, later 2021 and going into 2022, you have a lot of companies with very high profits. And one of the reasons for this is because everybody was just buying things in later 2021 and now into 2022. People are just buying things. It doesn't matter if the price of things are going up. People are still spending money. They're spending money at record speeds because, well, some people were just tired of the pandemic and some people were like, hey, I have some extra cash in the bank. I want to go and spend it. I have equity in my home. I want to go spend money. I'm not saying this is right. I'm saying this is just what's happening. So you have companies that are making money even though their margins might not be as big as they were before because they have higher costs of production, they have higher labor costs, and all these things going on. So they might have smaller margins, but they've been able to sell so much stuff because people just keep buying everything. And now a lot of companies are talking about doing buybacks. And so if they're doing buybacks, that means they're now taking this cash, they're not doing anything productive with it, they're not using this cash to build more manufacturing, they're not using this cash to invest in the future, they're not using this cash to innovate, they're using this cash to now just prop up the stock price. Now, this is great news if you are the investor in a company that's doing a buyback, but on a more economic level, buybacks don't have as much purpose. But now, again, who are we looking at? If we're talking about the investors, that's great because it's good for the stock market. This is why it pays to be financially educated, because when you're financially educated, you are the investor. You are the person that benefits when these things happen. So you want to be on the winning side. And JP Morgan Chase Bank says that we're going to see a lot of buybacks happen in 2022. That's going to help prop up the stock market. The third thing they talked about are limited systemic amplifiers. Sorry, I've been saying it wrong the whole time. I meant to say limited systematic amplifiers. English is my second language. That's my excuse. Anyways, limited systematic amplifiers. Now, I wasn't sure what that meant when the first time I heard that. I went to go search limited systematic amplifiers on Google and I got no results. But what I think they mean by limited systematic amplifiers are things that can amplify the problem. Things like maybe the pandemic, things like maybe more of the labor shortage, more of those type of amplifiers that can help these systematic problems that are going on with their economy. So I don't know for sure, so I'm not going to go too deep into that, but what they're saying is there are limited systematic amplifiers, and what I think is they have less of these systematic issues. The fourth thing that they talk about are positive January seasonals. So you have some companies in the stock market that are cyclical, some that are seasonal. A cyclical stock means it does well in a certain phase of the economy. When the economy is booming, that's when this company might do better than other times. So you could think of something like Gucci. Gucci does well when people have money. When the economy is doing better, it does better. Versus something like McDonald's, when the economy is not doing well, well then McDonald's actually benefits because then people are more likely to go out and buy cheap food like McDonald's. Maybe even Walmart. So that's what cyclical is, but seasonal is more of within 1 year. And what they're saying is they're seeing a lot of growth already in January 2022 where people are going out and spending money. And the way that our economy works is based on spending. The more money you spend, the more money somebody else makes. So if people are spending money at businesses, well, that means businesses are making bigger profits. If businesses are making bigger profits, well, that means the stock is probably going to do well because then people are going to say, oh, I want to go out and invest in this company because it's making a bigger profit. So that's the way that it works. And if people are spending money, well, then the system can continue running this way until people stop spending money, or if people run out of money, then one of these two things fall out of whack, and that's when things come down and that's when things have to correct. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.